Welcome to Social Security Post, your trusted source for reliable and clear updates on Social Security, retirement benefits, and financial changes impacting millions of older Americans. Today, we're diving into something both unexpected and hugely important. The long-promised plan to eliminate taxes on Social Security benefits has officially been dropped. But before you let frustration take over, here's the surprise. The replacement plan could actually benefit more than double the number of seniors across the country. That's right. While the tax cut plan is gone, a new $4,000 bonus standard deduction for seniors is stepping in to take its place. And for many, this might be the bigger win we didn't see coming. So what changed? Why did lawmakers abandon the popular no tax promise after over a year of hyping it? And how does this new plan really stack up? In this video, we'll break everything down, from legal roadblocks to tax code strategies, from income thresholds to who benefits the most and who might be left out. If you're retired or nearing retirement age, you do not want to miss this. Before we dive in, please do me a quick favor. Click the like button. And if you're new here or haven't done it yet, subscribe to Social Security Post. We're here to keep you informed, supported, and prepared. Now, let's get into what this new plan actually means and why it may be even better than what was originally promised. For nearly 2 years, one of the most talked about promises in Washington was the elimination of federal taxes on Social Security benefits. Millions of seniors hoped for relief from what many saw as a financial burden on already modest monthly checks. The plan was simple: stop taxing Social Security benefits and allow retirees to keep more of the money they worked for. It sounded like a no-brainer, and yet, despite all the public support and high-level discussions, this plan has now been quietly removed from the legislative agenda. So what happened? The answer lies deep in the rules of how Congress can pass laws, particularly through the reconciliation process. This process, established in 1974, allows lawmakers to pass budget legislation with a simple majority in the Senate, bypassing the usual 60-vote requirement. However, there's a catch. Reconciliation bills cannot include changes to Social Security. That's the law, and that's why the tax cut plan, which would have directly altered Social Security benefit rules, couldn't be included in the new mega spending package. It hit a legal wall, and lawmakers were left scrambling for a backup plan that could deliver similar or better relief without violating reconciliation restrictions. The solution they came up with? Replace the tax cut with a broader deduction strategy that avoids changing Social Security itself, but still provides meaningful relief. Instead of making benefits tax-free, Congress has decided to increase the standard deduction for seniors, and it's this pivot that could actually help millions more people than the original plan ever could. So let's look closely at this new plan. What lawmakers have done is expand the standard deduction available to Americans age 65 and older. Currently, most seniors already receive a modest additional deduction, typically around $1,600. Under the new plan, that bonus deduction is being increased to $4,000 per person. This is on top of the regular standard deduction, which for the 2025 tax year is roughly $15,000 for individuals and around $30,000 for married couples. This means that a single senior could now deduct up to $19,000 from their income before paying federal taxes, and a married couple could deduct over $34,000. That's a substantial reduction in taxable income, which could lower tax bills or even eliminate them entirely for millions of older Americans. And here's where the real power of this change lies. The original Social Security tax elimination plan would have only helped about 30 million seniors, the ones who actually pay taxes on their benefits. But this new deduction plan is available to every senior over age 65, regardless of whether they pay taxes on Social Security or not. That means over 70 million Americans now stand to benefit, more than double the original figure. To be clear, this is a temporary change. The expanded deduction is only scheduled to last through the year 2028, unless Congress extends it further. But during those 4 years, the potential savings are significant. If a senior has income from part-time work, retirement accounts, or investments, this larger deduction could zero out their taxable income and save them hundreds, possibly thousands of dollars per year. And for seniors living on fixed incomes, every dollar saved matters. This is not just tax relief, it's financial breathing room in a time when many are struggling with rising prices and unpredictable benefits. The new $4,000 deduction is designed to help the broadest possible range of seniors, but there are income thresholds to be aware of. The deduction applies to anyone aged 65 and older who has income below $75,000 per year as a single filer, or under $150,000 per year for married couples filing jointly. These thresholds were set to ensure that the benefit primarily reaches low and middle income seniors, who are often most impacted by taxation on fixed or limited retirement income. Let's break this down with a real world example. Suppose you're a single senior living on $30,000 per year, including Social Security, a small pension, or part-time income. Under normal rules, your standard deduction would knock off about $15,000 from your taxable income, leaving you with $15,000 subject to federal tax. But now, with the new $4,000 bonus deduction, you'll reduce your taxable income even further from $15,000 to just $11,000. Depending on other credits or deductions you may qualify for, such as for medical expenses or housing, your final tax liability could be zero. Multiply this example across the population, and you're looking at millions of seniors who can substantially reduce or even eliminate their annual tax bill. Married couples benefit in a similar way. A couple earning $60,000 combined could now deduct around $34,000 from their income, $15,000 each for the standard deduction, plus $4,000 each for the senior bonus deduction. That leaves only $26,000 subject to taxation before other deductions or credits are applied. The net result is a real reduction in taxes owed, and for some, complete exemption from federal income tax obligations. The only limitation is income. Seniors above $75,000 or $150,000 as a couple will see the benefit gradually phase out, meaning it reduces the higher your income goes. This is a common and very valid question. Many seniors don't file a federal tax return because their income falls below the filing threshold. For example, if your only income comes from Social Security and it doesn't exceed a certain level, you may not be legally required to file a return. So here's the question. If you don't file taxes, does this $4,000 deduction help you? The honest answer is no, and here's why. Deductions only matter if you file a return. If you're not required to file because your income is already too low to be taxed, then additional deductions won't apply simply because you're already outside the tax system. But that doesn't mean this new plan is a failure for non-filers. It means that, in truth, neither plan, not the now canceled tax elimination, nor the new deduction, would have helped these individuals. Eliminating taxes on Social Security would have made no difference to someone who wasn't paying taxes to begin with. So while it's frustrating to feel left out, it's also important to understand that you were already tax exempt. However, this could change if in the coming years your situation shifts. Say you take on a part-time job, withdraw funds from a retirement account, or sell property, you may suddenly find yourself required to file a return. In that case, this bonus deduction could be your best friend. It gives you built-in tax protection during the years it's available, all the way through 2028. So even if it doesn't apply today, knowing about it and how it works could save you significant money later on. It's a great example of how smart policy doesn't always benefit everyone at once, but when the need arises, you're glad the option was there. While this new deduction is a win for most, it's not without its limits, particularly for higher income seniors. Individuals earning above $75,000 per year and married couples earning more than $150,000 will begin to see the benefit reduced. For example, if your income is just slightly over the threshold, you might still receive a partial deduction, but if you're earning well into the six figures during retirement, you'll likely see no benefit at all from this change. This might feel unfair, especially if you were expecting the promised elimination of taxes on Social Security benefits. After all, for seniors making over $100,000 per year, taxes on benefits can be significant. If the original plan had gone forward, this group would have saved thousands. But from a policy standpoint, Congress had to make a choice: provide full tax relief to a smaller, wealthier group, or deliver partial relief to a much larger group of seniors who are closer to the edge financially. By choosing the second path, lawmakers designed the deduction to provide broader coverage, even if it meant leaving out some higher earners. That said, if you are in that upper income tier, It's important to note that while you may not receive this bonus deduction, your income already allows you access to a wide range of tax planning strategies, from Roth conversions to charitable giving deductions. There are plenty of ways to manage your tax burden effectively. The $4,000 deduction might not apply to you, but that doesn't mean there aren't other options worth exploring. This update simply means that the policy focus, at least for now, is on helping the widest group of seniors possible, particularly those living on Social Security and modest retirement income. Now let's bring it all together and compare the two approaches: eliminating Social Security taxes versus adding a $4,000 deduction. Which would have helped more people? The original plan would have removed taxes on benefits for roughly 30 million seniors. That's no small number, and the savings for individuals who were affected could have been substantial. But it had a narrow scope. It only applied to people who were already paying taxes on their benefits. In contrast, the new deduction helps over 70 million seniors, a much broader group. And while the individual tax savings may not be as dramatic as the original plan, the total impact across the country is significantly larger. More people benefit, more seniors can reduce or eliminate their tax burdens, and perhaps most importantly, the new deduction does not touch Social Security itself, which makes it legally viable within the current reconciliation bill. In terms of practicality, political reality, and fiscal reach, the deduction plan is actually a smarter and more effective policy. It may not sound as exciting as no more taxes, but it gets more results for more people, and that's what ultimately matters. So what you take away from all this? The long-promised plan to eliminate Social Security taxes may be gone, but it's been replaced by something that could actually help more seniors more consistently over the next 4 years. With over 70 million seniors eligible for a bonus $4,000 deduction, the scale of this policy shift is huge. It won't help everyone equally, especially not higher income retirees or those who don't file tax returns, but for the majority, it represents meaningful tax relief and more money staying in your pocket. If you're not already subscribed to Social Security Posts, now is the time to do it. We'll continue to break down complex policies in simple language so you can stay informed and make the best decisions for your future. Please like this video, subscribe to the channel, and share this with someone you care about, whether it's a parent, neighbor, or friend. Knowledge is power, and with the right information, you can make the most of every opportunity that comes your way. Till next time, take care and stay ahead with Social Security Post.